Welcome to the SWIB Market Update. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB. Each quarter, we will talk to SWIB staff about the economy, the markets, and how the Wisconsin Retirement System trust funds are impacted. We will also discuss how SWIB is working to help the WRS remain among the nation's most resilient pension funds, growing and protecting participants' benefits, and giving them peace of mind to focus on work, life, and the future. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find this show. Joining us today is SWIB head economist and asset and risk allocation chief investment officer, Todd Matina. Todd, thanks for joining us.
Thanks, Chris. Great to be back with you. And thanks again for having me on the podcast.
Let's start, Todd. If you could just give us a general update on the economy.
Sure. So we're closing out the first quarter of 2025 amid a pretty sharp rise in economic policy uncertainty. Since the new administration took office, proposed changes in tariffs, taxes, and immigration policy have created a more challenging outlook for both businesses and investors to navigate. That uncertainty has shown up in several ways, market volatility being one of them. Earlier this year, for example, the S&P 500 experienced a so-called technical correction, falling over 10% from peak to trough during February and March. This isn't surprising when you look at the broader mood. Various indices measuring economic uncertainty have jumped since January. Now, what are the leading economic forecasters saying about the U.S. economic outlook? The forecasting surveys show a stagflationary shift, so lower growth and higher inflation. But the overall picture remains solid. The average forecaster still expects about 2% growth this year, inflation just under 3%, and unemployment of around 4.2%. In other words, we're growing above trend, inflation is above the Fed's 2% target, but it's not spiraling, and the labor market remains around full employment. Now, that said, the outlook is still highly uncertain. A lot depends on how the administration's policy proposals evolve from here. Economists and investors are watching to see if business investment and hiring decisions slow down due to the regulatory and fiscal uncertainty. So far, we don't have much hard economic data for 2025, such as income and spending figures. So markets are leaning more on the so-called soft indicators like consumer sentiment surveys. The University of Michigan Sentiment Index, which is widely followed, has dropped more than 10%, hitting levels seen in past recessions. The Conference Board survey also declined, though less dramatically. More concerning for the Fed, I think, is a spike in long-term inflation expectations. The University of Michigan survey now shows consumers expect inflation to average over 4% in the next 5 to 10 years. That's the highest rate in more than 30 years. On the bright side, market-based measures of long-term inflation remain well anchored. So investors, at least, haven't yet lost confidence in the Fed's ability to deliver on its 2% inflation target over the long term. Markets are actually still pricing in about 3 rate cuts this year, but that could change if inflation expectations stay elevated. So the Fed will likely remain in a wait-and-see mode. They'll want to ensure that rising consumer inflation expectations are not spilling over into the financial market expectations of inflation. We also have some nowcasting models to consider for growth. For example, the Atlanta Fed's real-time GDP tracker suggests the economy could be contracting in the first quarter at an annualized pace of about 2.8%. Now, that's just one point, but it does reflect the growing uncertainty we're seeing.
Todd, can you talk a little bit about how the proposed tariffs and tax changes affect the economic outlook?
Sure, Chris. Let's take a closer look at those potential policy impacts, particularly the trade and tax proposals. So tariffs are a big topic right now. Economically speaking, in principle, they tend to act like a one-time increase in the price level, not a persistent inflationary force. But they still impair output, like any tax would do. The Congressional Budget Office and Brookings Institution model suggest that if the proposed tariffs are fully implemented as advertised, they could raise inflation by somewhere between 1.25 and 1.5 percentage points relative to a pre-tariff baseline, and cut GDP growth by around 0.25% to 0.5% relative to a pre-tariff baseline. That's not enough to trigger a recession on their own, but it's definitely a headwind. We also shouldn't overlook important sector-specific effects. In autos, for example, supply chains cross borders multiple times. Tariffs in that space could cascade one on top of the other and result in sharply higher final prices for consumers unless the tariff package is well designed. And the pandemic taught us how fragile global supply chains can be in these types of scenarios. A rapid tariff increase could function like a supply shock. Now, turning to taxes, the extension of the 2017 Trump tax cuts is another hot issue, although it's received less headlines or airtime in the last couple of months. It's still an important issue coming up. Key provisions like lower individual tax rates are set to expire shortly. Making them permanent would avoid a near-term fiscal cliff, which would be a drag on the economy. But it comes at a long-term cost. The federal budget deficit is already running at over 6% of GDP. That's about a $1.8 trillion deficit. And that's at a time when the economy is operating near full employment. It's also well above the historical average of about 3.75% of GDP. So even without further tax cut, the Congressional Budget Office is projecting that federal debt will rise from around 100% of GDP today to 155% of GDP by 2055. Eventually, the federal government will need to rein in its budget deficit to put debt on a more sustainable path. And when the next recession ultimately hits at some point, automatic stabilizers are going to kick in, and that's going to be reducing tax revenues and widening the budget deficit even further. The main risk here is that the bond market eventually loses patience at some stage and demands higher interest rates as compensation for this higher long-term fiscal risk. And that would have ripple effects across asset markets.
And finally, Todd, what are the economic drivers of long-term stability of the Wisconsin retirement system?
Sure, great question. So zooming out, let's talk about the long-term economic drivers of the WRS, the Wisconsin retirement system, in terms of its financial stability. And SWIB, after all, has a long-term investment horizon, which is well aligned with the long-term horizon of our pension obligations. Now, from that long-term perspective, the fundamental drivers of the WRS's financial stability include average inflation over time, long-term productivity and economic growth rates, and finally, market valuations of the key asset classes that we invest in. Today, long-term inflation expectations remain reasonably well anchored, as we discussed previously. The Fed is still running a moderately restrictive policy to try to keep it that way. And in that context, the Fed's going to need to proceed carefully with further interest rate cuts to ensure that inflation expectations don't start creeping higher again. Now, turning to productivity growth and labor force growth, we've seen that those have both been slowing. So the long-term trend for real GDP growth is likely to be somewhere in the neighborhood of 1.7%, so a little bit lower than where we are expected to turn out in 2025. Importantly, we need to keep an eye on AI, artificial intelligence. If it delivers the meaningful productivity gains as promised, that could reverse a multi-decade trend we've seen in declining rates of productivity, which have fed into a declining average rate of GDP growth. So we need to keep a close eye on AI. And turning to the third key factor, market valuations also matter. U.S. equities, especially large cap stocks, remain richly valued today. And that's despite coming down in price in recent weeks. And that suggests a lower expected return in stocks going forward over the next decade or more. But on the flip side, we've seen a surge in bond yields since 2022. And that's made fixed income more attractive than it's been in many years. High starting yields mean higher expected returns in bonds over the long run. So while the near-term outlook is clouded by policy uncertainty and soft data signals, our long-term focus remains steady. We continue to monitor the key trends, both macro and market-based, to make disciplined, informed investment decisions for the benefit of our members.
Todd, that's some great information. Thanks for taking some time to give us an update on the markets and the economy.
Thank you. It's been a pleasure.
The SWIB Market Update is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com. Thanks again for listening. I'm Chris Preisler.